On the couch this week, Marcus Padley from Patterson Securities and author of Marcus Today newsletter, the senior business columnist with the Sydney Morning Herald and The Age, Liz Knight, and senior research analyst at Wilson HTM, Ivor Rees. Welcome, everyone. Lots of uncertainty. That means nobody knows what the hell's going to happen. But you guys are in broking. What are you telling investors? What should investors do in the context of all this uncertainty?
Ivor?
My firm's advice to people has been for a while to stay in cash and fixed interest and have, be very, very conservative. And I think that advice has remained the same. There has been some talk about, are we at the bottom? Can it get any worse? But I think our house view, our strategy is that it could get worse, and the European, the resolution of the European crisis is probably going to take 12 months to work out, so you're going to have plenty of opportunities to rush in and buy stocks.
Because there is some research going out there, and I'm sure some viewers are getting phone calls from their brokers saying shares are cheap.
They're cheaper. The shares today are cheaper than they were at the depth of the GFC. So, the equity risk premium is higher than what it was after Lehman Brothers collapsed.
So doesn't that make it a buy? No.
Technically, it's a technical buy, but whether people have the confidence to do it, there's lots of technical buys there, but I don't see a lot of buying going on. Volumes are extremely low. People are just sitting on their cash.
Back to you, Marcus.
Alan, this is the game, right? You've got to do this. Right.
I think you're out of shot. Are you in shot?
And get everybody off your assets. You've just got to
protect your assets.
You've got to look after whatever you've got. The game is not trying to make money. It's not losing any more money. And, there's an absolute tempest going on out there, and to sit in a boat in the middle of it when you could stand on the shore is ridiculous. You have to see all this risk gone before you can get back in the market. And a lot of people have already done that. But the people who are employees who are still having 9% of their money slotted into managed funds, which are, conservatively would be 50% equities, are just going to wear it. And, the game at the moment is keep what you've got. And it doesn't matter if you're earning 2%. If you need income, spend the capital. It's far better than putting it at risk.
Yeah. You talk to a lot of people, Liz. I mean, what's the sense about how it's going to unfold?
Well, I mean, there are so many more stocks in the market ultimately trending down than trending up. I mean, both these guys are right. The risks are huge. But, of course, the problem is that if your investment is via managed funds, you don't really sort of have that day-to-day choice. So all these people in super, unless, of course, you're managing your own, for the most part, are in funds that have a certain allocation in the equities market, and they are, taking a bath on the back of that.
The other critical problem in Australia is we don't have a bond market. There's nothing to buy. We have, relative to the pool of money we have trillions and trillions of dollars. And what's the size of the available investable funds? It's less than $100 billion. So there's nothing for people to buy. You've basically got to go overseas to buy fixed interest.
So what about looking for yield on the stock market? Just, looking for safe yield?
Well, that's what mum and dad investors have been doing. They've been buying the Telstras, they've been buying the banks, they've been buying the utilities. And, if they've done that, they've probably preserved their capital over the last 12 months.
And the other thing people have been doing is looking for situations to get into. We'll get on to some of the takeover rumours in a moment, but one of the hot areas was mining services for a while. How's that going?
Well, I think mining services in aggregate's down about 40%. It's really crushed a lot of people in the funds management industry, and it's hard to see that sector bouncing back because the emperor's got no clothes now, so everyone's just going to be selling that for the next 12 months.
You remember Bradkin had a profit warning recently. The day after, excuse me. The day after Bradkin had their profits warning, there were 6 brokers with buy recommendations, 2 upgrading to a buy.
And what
the share price was $7.55. The average target price was $9. It was down from $8.50, so it's down $1 in a day. And the target price was $9. Everyone was a buy, and the share price is now $5.60, down 25% further. Mining services bubble.
And what are all the analysts saying now? Still buy or
I think
sell?
they're still buy. I haven't, but that was I just got the research out from that day.
You see that pattern happening all the time, not just in mining services. You see things that are coming out with horrendous profit announcement statements. The share price goes down, and the brokers just jump in and put a buy in it, and it just keeps going down.
The problem at the moment with the market that's so risky, and you've got to wait for that risk to go before you start looking at value. No one's looking at value. No one's reading the research and going,
really
"Oh, I believe that."
Value is. I mean, it's relative to where it was yesterday. Yeah, exactly.
And that sort of stuff. So, and we actually look at the stocks that are trending. 70% of the ASX 200 is trending down at the moment, and there's 20% that's trending up, and it's all utilities, healthcare, Telstra,
And
REITs, real estate and investment
and
trusts,
good
all the
yielding
and
stocks.
defensive stocks like Coca-Cola.